Ladies and gentlemen, welcome back to the Capital Flows podcast. In today's session, we are going to cover why markets overreact and break down a lot of the forces behind them as they're expressed in what I like to call an agent-based framework, which just means who are all the different players in markets? What are their constraints? What are their expectations? And how do they fit together so that we can have a view into markets that's more than just looking at technical levels or recent changes that took place, but actually dig into the why behind changes in asset markets as they connect to different players. And so the first thing that I want to do is break down the different players, and then I'm going to connect that to where we are in markets right now. And I think that'll be really key, because if you can understand the different players in markets, how they act, why they act, their incentives, their constraints, their goals, then we can connect that to how the forward curve is being priced right now, or how earnings are beginning to change, or how inflation expectations are adjusting. All of those different things are linked because all of the different players in markets are linked to other players, and they all have a connected relationship. And so we're going to break those down and then connect them tangibly to what we are seeing in markets right now. When we look at the economic agents, or the main agents in the system that we have, there are investors, retail and institutional, central banks, firms, or corporate executive, corporations, whatever you want to call them, household, which is just the consumer, policymakers, whether that's governments or regulators, whatever that might be, and then financial intermediaries, which are banks, insurance companies, hedge funds, any type of financial institution like that. Each of these agents have differing goals, differing constraints, and differing expectations. And these shape their views on economic events and influence the broader market. When you think about why is it that you can buy the dip in stocks, or why is it that you have different strategies like a trend following strategies or whatever that might be, why did those even exist and can they take place? And fundamentally, it is about how different agents in the economy have different goals and provide some type of return or incentive for other agents in the economy to warehouse that risk or to take on a trade-off that they don't want to, really warehouse on their books. And so understanding these different agents is the starting point. And then understanding their different goals and constraints and expectations. And then we can begin to frame, okay, here's how the different agents fit into why markets are doing what they're doing. When we think about investors, we have a very simple breakdown of who they are and what they're doing. Their goal is to maximize returns on their investment while managing risk. And then you have institutional investors that have a fiduciary duty to clients. The idea that the institutional investor is, really the ones who know what they're doing or something like that, that's really, broadly speaking, in markets kind of a misnomer. Like, there's not a ton of evidence behind that. Institutional investors are agents in markets that just have a different type of goal and role, and sometimes they do a great job at that, and sometimes they do a poor job at that. In the same way as retail, or if you even want to call it retail, anyone who is not under an institutional mandate and regulated, retail is, fundamentally they have some amazing returns sometimes. They do an amazing job, and then sometimes they do a horrible job, right? And you have trade-offs between different periods of time with those. And so the constraints are a lot of different things surrounding liquidity requirements, risk tolerance, time horizon, and then a lot of times regulation, depending on where you fall on the spectrum of retail and institutional. And retail investors are often more influenced by media narrative, personal experiences, herd behavior, things like that. and may overreact to news, causing sharper price movements, things like that. While on the institutional side, you rely more on financial models, specific mandates, quantitative analysis, everything like that. And then a lot of times institutionals are a lot more slow moving. So many times retail will operate on shorter time horizons. With that being said, both of these are very malleable, is what I would say, between the two players. And when you look at the actual flow in markets and how things change, you see mistakes from either one of those participants. And there's different ways to measure that from different participants. And so what is important to understand is that both of these agents fall into the same category in terms of their goal in markets, which is what? To maximize return and manage risk. Sometimes there's other constraints that fall into that, but that's their main goal. For central banks, their goal is to maintain price stability, control inflation, support employment, all of the major things, and they have their tools to do that. So the constraints that they have is they have limited ability to control global financial conditions. For example, they can't stop an oil shock from war in the Middle East. They don't have control over that. But those higher energy prices will directly feed into CPI, which is what we saw in the last print. And then things like political pressures, again, you can have some political pressures that can or can't have an impact on the Fed. For example, this past week, we saw news that Trump was going to fire Powell. Again, still hasn't happened. And there's a reason for that, because you would actually have to go through Congress and have a lot of changes, and you would have to really maneuver around the entire system and go through due process to be able to have that happen. So that's all, it's political pressure, but it's still a constraint on, let's say, Trump, that he can't just, fire Powell, or else he probably would have already. You have all the time lags that, again, the central bank can't really control, and you have just beliefs and expectations around central banks, which is their ability to influence the economy through interest rates and quantitative easing or tightening. And the key thing here is central banks believe that they can do this, but there are varied degrees of transmission that those interest rates can have into the economy. And so the way that the Fed responds and their expectations and beliefs around their abilities frames how interest rates begin to play out. And, we're going to start building these different agents on each other and explain how they connect, but you can begin to see how, okay, you have a limited ability to change financial conditions, but think about it. You have the other firms previously, other agents, such as retail and institutional, who they can warehouse risk from financial conditions a lot of times. For example, they can come in and short oil and provide some liquidity for, short-term stability that took place from the shock in the Middle East that took place, a couple weeks ago now. So you can see how, the central bank can't control the crude oil market, but a short-term imbalance, you can have investors come in, warehouse that risk by providing liquidity so that you can smooth over the prices that take place. And, the degree to financialization we have in today's world is one of the reasons why we don't have the crazy price changes like we had in, for example, like the 1800s, late 1800s. If you look at an oil price chart, it's wild. Same with the 1970s. Again, a lot of things have changed since then, not only in the economy, but also financial markets. The next agent that I want to cover is just corporate executives, firms, functionally corporations, and their goal is to maximize profit and to ensure the long-term viability, maintain a competitive advantage. They're going to have operational limitations. They're going to have regulatory constraints, market competition, and capital availability. All of those things play into their ability to make money or lose money in the market. That directly connects to earnings, and that directly connects to their stock prices. Firms base their expectation on future consumer demand, interest rates, economic growth, and their beliefs about inflation, the future labor market, and consumer spending will directly influence pricing decisions, hiring practices, and long-term investments. So, for example, if a corporation believes that there are risks on the horizon and they start laying off people or stop hiring people, what can that feed into? It can feed into central banks saying, hey, we need to cut rates because the labor market is weakening, and it can feed into investors having less capital to deploy, which means you can begin to have capital move back from the risk curve. Institutional investors raise cash, retail investors have less capital to deploy, and it reverberates all around the different agents. The other agent is households. And households is overlapped a little bit. Obviously, if you're a household, you have some type of asset somehow, even if it's really small. And they are the ones that are consuming all the goods and services from corporations. So you have corporations and small businesses that make all the stuff, and you have households that are the ones that buy all that stuff, and households are made up of all the different people that work for those corporations or small businesses. And so those two things are linked. And so their goal is to maximize their household welfare, ensuring a good standard of living, and accumulating wealth for the future. They have a certain amount of disposable income and savings. However much savings they have in surplus, that goes into financial markets, and that's how they become an investor. Borrowing capacity or credit limits, that is another thing, because if they don't have a good credit rating or if incomes start following, then financial institutions don't want to lend to them. And then they just have time constraints, which is, everyone likes to talk about like, well, just have a long-term mindset. Well, newsflash, a lot of people want to, retire at 60 and want to have enough money to actually retire. So everyone has a time horizon where they need a certain amount of returns so that they can meet their retirement goals. And so households form their expectations about future income, inflation, job security based on both personal circumstances and macroeconomic signals. For example, wage growth, unemployment rates, interest rates, things like that. Optimism about economic conditions might lead to increased spending, while pessimism could result in higher savings rates and reduced consumption. What does that mean? It means that households are fundamentally trying to always be able to maintain their job, maintain their standard of living, and if they feel better about that, they're going to spend more money if they have that money to spend. What I will say is that the optimism or pessimism of the different consumers or households, they do have constraints because you only have so much money to spend. You can be optimistic through the roof. You can manifest all the reality that you want. But if you're not making more money, you don't have money to spend. And at the end of the day, your credit cards or whatever it is, those have constraints and limits. And so the important thing to say is, yes, optimism, pessimism, the consumer, their stance through different periods of time, for example, like Christmas or a summer vacation, and the propensity to spend during those times, those can feed into spending. But remember, there is going to be a constraint and a limit on how much they can spend. And yes, that can be fueled by credit or things like that. But guess what? That amount of credit is going to directly connect to financial institutions, which we're going to cover in a second. Policymakers are the other agents in the economy that are directly linked with all of these flows and all of these different changes. Their goal is to stimulate economic growth, reduce poverty, theoretically, not doing a great job, but provide essential public services and stabilize the financial system. Their constraints are budgetary limits, so taxes versus public spending, political factors, and then legal and institutional limits on intervention. So, for example, in the U.S., budgetary limits are directly connected to mainly your debt ceiling, which they keep raising, and then also the deficit that they have, which, again, we're beginning to see some constraints on that with the level of interest rates and that feedback loop. Obviously, political factors between Republicans and Democrats that begin to try to push through bills at different periods of time, depending on elections and public opinion and things like that. And then obviously we have in the United States specifically the legal and institutional limits on intervention. For example, the three branches of government that we have that have checks and balances on each other, and that, makes up, the democracy that we have today. Governments base policy decisions on projections about long-term growth, employment, and inflation. Their belief in the effectiveness of fiscal stimulus, tax policy, or regulatory changes often shapes the overall economic policy agenda and their approach to managing the business cycle. Let me give you an easy example of this. Right now, the US government wants the Fed to cut interest rates. The problem with that is if the Fed cuts interest rates, that injects more money into the system. The only way to neutralize that amount of money in the system is, well, there's a couple of different ways, but one of the main ways would be raising taxes. And politically right now, not a cool idea to raise taxes, right? It would not be palpable to public opinion to raise taxes. Everyone hates that idea. But there are all these different levers which, if you have a central bank and policymakers work in tandem, they could actually have a lot more control over growth and inflation in the economy. But since you have Republicans and Democrats as policymakers that are always disagreeing, and then you have a Fed chair who, is not really, having a great time with either, and you have this thing called central bank independence, which you can say it's good or bad. What that does is it creates a divergence between policymakers and the Federal Reserve and the central bank. That divergence creates opportunity for investors and traders to be able to make up that spread between the divergence that they have. And I'll explain how that works. The last one is financial intermediaries, which are just banks, insurance companies, hedge funds. Their goal, generate returns for stakeholders while managing risk. They often try to maximize profits by taking calculated risks across various assets. They have a lot of regulatory constraints and requirements. Risk management frameworks, obviously, market liquidity and access to capital for trading or lending, another constraint that they have. And, kind of depends on how you frame that exactly, because you can say they have more access, but they're also a bigger player, so kind of depends. Financial intermediaries, especially hedge funds, are typically forward-looking and highly sensitive to shifts in market sentiment, macroeconomic data, things like that. Their beliefs about interest rate movements, inflation expectations, and financial markets conditions directly influence their trading strategies, risk appetite, and leverage. So these different financial intermediaries are directly connected to things like banks creating money in the economic system by issuing debt. A lot of people like to talk about how the Fed prints money. The commercial banks are the ones that create, the majority of the money in the system, fundamentally from credit. And that actually creates money in the economy, whereas the Federal Reserve, they're primarily working with reserves or different things like that in the financial system that are, there's a reason why the Federal Reserve's liabilities are not legal tender. What that basically means is the Federal Reserve is not like, the hyperinflationary policies of the, in like Weimar Germany back in the day. It's very different, right? The Federal Reserve doesn't have the ability to take money and give it direct to consumers. So commercial banks are the intermediary who facilitate the public market liquidity and, basically use that public market liquidity and be able to issue credit to the real economy. In the same way, you have hedge funds who help smooth over the different changes in financial markets and prices so that you can have a greater degree of risk-taking and a greater degree of, issuance of credit and things like that so that there's more stability in the system. The more stable that the system is, the more risk people will take and the more capital that you can have that will have the ability to, create real economic growth. For example, if you have a lot of changes in asset prices, whether that's interest rates or anything like that, people are less likely to invest in the next greatest startup that's going to change the world. Now, the bears will always say that, well, yeah, but it also creates malinvestment. That's all part of the process. It's all part of creative destruction. But, fundamentally, when you have a greater amount of liquidity in the system, like liquidity in financial markets, tighter spreads, less, wacky moves all over the place, again, like oil, back in the day. When you don't have that, it allows people to have a more certainty, which allows them to specialize more and allows them to really nail down their core competency and leverage that to its maximum ability. So the idea that I've laid out so far is that there are different economic agents in the system. The thing I want to bring us to now is how they have conflicting beliefs about the future. When you understand the conflicting beliefs, then you can begin to understand how that connects to financial markets. So investors might overreact based on emotional or biased responses, fear or greed, especially during periods of volatility, amplifying price swings. Central banks try to stabilize prices, but here's the trade-off, may inadvertently exacerbate volatility by acting too slowly or too aggressively based on imperfect economic forecasts. Again, the savviness you have of whoever the central banker is at this time, that will determine how good they are at acting too slowly or too aggressively. Right now, Powell is acting too slowly and he's being too accommodative in the stance for financial conditions. That's pretty clear. And if you haven't seen that, you can see it on the Substack. I'm laying it out, and we'll go over that in a moment. Firms, or corporations, might make decisions that increase supply and demand and raise prices, unknowingly contributing to inflation, deflation, based on their economic outlook. So this firm, corporations, have a direct impact on price stability that the central bank is trying to control, and those changes can impact asset markets, which investors can exacerbate, right? And households can increase consumption during periods of optimism, pushing demand to unsustainable levels, right? Which would cause, central banks to try to raise interest rates, which could impact corporations. And then corporations could lay off households, which would then decrease consumption. It's all connected. And then they could also reduce consumption based on fear of economic decline. And then financial intermediaries react to economic data, adjust their portfolios, sometimes exacerbating short-term moves in the process. The idea is that all of these different agents are impacting each other. And sometimes when one of the agents needs to make a decision that creates volatility, another agent in that system can warehouse the risk. For example, if central banks need to change policy, investors or maybe a financial intermediary or someone like that can come in and warehouse that risk and be able to smooth over that volatility. The issue becomes when all of these different agents are not offsetting each other through the economic cycle, but are all capitulating at the same time. When all the agents are capitulating at the same time, you have one of two things, a melt up or a melt down. And that's how you actually have massive rallies in equities and massive sell-offs in equities, because you have all of these agents capitulating and the capitulation feeds off each other instead of offsetting each other. So, how does this tangibly connect to markets, and where are we right now? In the current economic environment, understanding how economic agents' beliefs and their expectations influence interest rates, equities, inflation is crucial for identifying opportunities and risk. So we're going to break this down so that we can understand where we're at right now. Investors, how does that connect to them? Right now, investors are trying to figure out this entire inflation expectations thing, not doing a great job, how many rate hikes or rate cuts we're going to see, and then growth concerns, supposedly so, as inflation fears persist, and they're trying to adjust their portfolios based on the environment that we're in. What does that tangibly look like? The easiest example that we will go over is this chart, which is of the Bloomberg Commodity Index in white, and then bonds, which is I use the TLT ETF, in blue. And what you will notice is that if you are trying to increase your returns, for example, and people are like, well, just be a long-term investor. If you need to retire in 10 years, which means you need to have a certain growth rate, let's say you need a 10% growth rate or an 8% growth rate, or else you can't retire in 10 years, and your job probably not going to be around in 10 years, and you say, I need to have this certain growth rate, then you are going to intentionally take risks to be able to achieve that return, because not everyone is in the situation that you're in. And so that's why there are people with different goals and constraints in markets. Maybe someone hasn't made enough money, or they lost some money, or they had to pay for, some child or spouse's surgery that took a lot of money, and now they need to kind of make up for some lost time, and they're on a fixed income. Those are the types of things and situations that are different across every consumer, every investor across the entire economy and world. Here is an example where you have the Bloomberg Commodity Index in white and then bonds in blue. If you had bought bonds, right, you would be in a drawdown right here. And then if you had bought the commodity index, you would have been able to be up during this time. The key thing to understand is when you move through different macro regimes, people will want to overweight or hedge their bond exposure or something like that with a product like the Bloomberg Commodity Index or some type of other exposure to commodities or gold or silver or things like that. So that's why those allocations can be really important, especially if you time those allocations with the macro regime that exists. The other thing about how these agents connect tangibly to financial markets is central banks, particularly the Federal Reserve, has been an aggressive stance of raising interest rates to combat inflation over the last 4 years. So those tightening policies directly impact bond yields, and they influence the pricing of future rate hikes or cuts and the forward curve. And so the question is, we've had all these rate hikes over the last 4 years. Now, are we going to have more cuts, or are we going to adjust to a new norm? And the forward curve reflected either Fed fund futures or the SOFR contracts that we all trade. Those are the derivatives that price the actions of the Federal Reserve over the next, let's say 6 years, 4 or 6 years, whatever you want to call it. Those are going to reflect the actions of the Federal Reserve, and they are going to represent the market's expectation about how the Fed will act over the next couple of years. You will notice right here is just a breakdown of the Fed fund futures and how they're pricing risk. Right here in this category right now is the implied interest rate by the market, by these derivative contracts that directly impact interest rates across the curve, and how they're pricing risk. So you will notice that right now for the next meeting, there is no implied interest rate priced. There is, basically the market is saying no rate cut, which is the baseline. They've already had plenty of time. If they wanted to do a cut, they would have, adjusted, and, inflation is rising right now, so it's not on the table. The entire question, though, is in the next couple meetings, are they going to cut? Because the next meeting is pricing 16 bips, and then the next meeting after that is pricing 28 bips. And then by the end of the year, we're pricing 45 bips, which is just under 50 basis points, which means 2 rate cuts. So the entire question is, will the Fed cut by 45, or what it would be 50 basis points right here by the end of the year? If they don't, these derivative contracts have to reprice, pushing interest rates higher, which will reverberate across the interest rate curve and begin to impact, again, who? Corporations, consumers, everyone else, right? And so this plays into, okay, well, how are corporations going to fit into that, and how do they tangibly connect to these changes in markets? Despite the higher interest rates that are happening right now, companies are adapting strategically to the evolving economic environment. While supply and demand input costs are being managed carefully, many are successfully adjusting their growth expectations to remain resilient in the face of tighter monetary policy and shifts in consumer behavior. What does that mean? It means that corporations are being resilient enough to interest rates and are adapting enough to take advantage of growth that they are thriving and advancing, which is reflected in the rally in equities, specifically in the rally of the Russell 2000. The fact that small cap, cyclically sensitive companies are increasing earning expectations and rising and growing, those are indications of this type of reality. This adaptability is positioning them for long-term success as the market adjusts to a more stable interest rate environment. Here is just a breakdown of the S&P 500, the price targets of analysts, and the deviation of it below. Basically, what we're seeing here is expectations are rising for companies, for the price targets. We're seeing resilience in earning expectations, and we're continuing to see strength in the underlying economy as it's reflected in earnings and equity markets. So, where are we right now with how this connecting to households? Households are demonstrating resilience while mortgage costs, auto loans, credit cards have risen, the costs of them. The tight labor market, aka strong labor market, continues to support consumer confidence and spending. Delinquencies in the real estate sector remain low, reflecting strong financial conditions within households. At the same time, money continues to flow into passive investment vehicles, which further strengthens market stability, offers growth opportunities even in a more challenging interest rate environment. Here is a chart of delinquencies for mortgages across all the major types of mortgages. You will notice that it is still incredibly low. We just got back to 2019 levels. And then when we look at housing prices, the Case-Shiller home price index remains at highs. Now, are there regional changes here and there? Yeah, sure, of course. Everyone knows that. The entire question that we're talking about when we're approaching things from a macro perspective for things like interest rates is that when we pull everything together on an aggregate basis, home prices remain resilient. And that's why interest rates remain higher, because we're not seeing a collapse as we saw during the Great Financial Crisis. And again, that connects back to the strong labor market and the resilient consumer. You will also notice that the strong labor market is directly connected to initial claims, and this has been in a range right here for a period of time. And then here's just a chart of passive flows and passive investment vehicles as a percentage of the overall market. We just hit 60%. Money continues to flow into there. How are we going to connect all of this tangibly to managing risk, active trading in equities and Bitcoin, things like that? How do we pull all this together? And what I've done is I recently published 3 different primers on the Substack explaining how to think about the S&P 500 through these different regimes, how to understand Bitcoin in these different regimes, and then finally, how do we build a falsifiable investment thesis based on macro principles? So we have all these different agents. We have their expectations and constraints. We have a big picture view of how things begin to work. Now what we want to do is connect them to the underlying drivers of asset prices, and we want to build theses correctly so that we can adjust our actions accordingly. So these 3 different playbook primers, wherever you're watching this, they will be linked below. If you're watching this on Twitter, there'll be a link below for it. And then if you're watching on YouTube, there'll be a link below for it as well. Each of these are 100% free. And then also for all the major macro views, if you want to say, okay, well, where is the consumer right now? How are central banks' stance? What is their stance right now for how the evolving inflation picture is beginning to take place? All of that is laid out on the Capital Flows Research website. The most recent report on the credit cycle, money and monetary correlations is laid out here. That explains how all of these different factors come together. And then obviously on the YouTube channel, if you go back and look through all the recent videos, these explain things like the policy error that the Fed is making right now, and then also how this transmits into the dollar and just the credit cycle overall. So those are the big picture ideas that I wanted to cover. Those are the economic agents that we have in the system, and I will be laying out more of these ideas on the YouTube channel and on the Substack for subscribers. And with that, I will see you guys soon.